Thank you for giving me the opportunity today to present LEG Immobilien to you. I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. I would like to structure my short presentation today into three segments. First, who we are. Secondly, why we are different. And thirdly, how we achieve climate neutrality by 2045. With regard to the first point, who we are. LEG is the only pure-play real estate company in German residential, i.e. we are the third largest German residential company with around 145,000 units. Our focus is on affordable living. We offer residential space at a price of just below 6 euros per square meter. At an average size of 64 square meter per flat, we are talking about an average rent of around 380 euro per month. You should be also aware that 24% of our units are rent restricted, i.e. tenants are supported by the state and rents are lower than for the free finance part of our portfolio. On this slide, you see our geographic spread. So our home turf is North Rhine-Westphalia, where we are the market leader. NRW is one of the biggest states in Germany, accounting for around 20% of the German population and about 22% of the German GDP. In order to grow our platform, we started already in 2019 to expand into adjacent states outside of NRW. And we made a major step in 2020 when we bought into several locations outside of NRW. Currently, 12,000 units out of our 145,000 units, or 8% of our platform respectively, are now in adjacent locations. There we follow a prudent acquisition strategy. As you see by the color of the circles, we divide markets into three segments. The segmentation is done by more than 50 indicators, which take into account drivers like rent level, vacancy level, demographics, labor market, economics, and future attractiveness. So when we acquire units outside of North Rhine-Westphalia, we focus on the orange and green markets, or as we call them, high growth and stable market. Those markets come with lower risks, but also with lower yield. Once we know the markets and have our organization established, we could also buy into purple markets, or as we call them, higher yielding markets. For new locations, we require at least 1,000 units to efficiently set up own people on the ground. Within North Rhine-Westphalia, however, we buy also small portfolios. Typically, we already have some units across the street, for example, and those new units come at no incremental cost. Since our IPO in 2013, we continuously grew our portfolio and we offered our shareholders attractive returns, be it via the increase in our NAV, which grew on average by 14% per year, or via the increase of our dividend, which grew by 12%. Our latest NTA figures, which is the new NAV, stands at 124 euro per share. This does not reflect effects from revaluations, and we only reflect those on a semi-annual basis. So for H1, we expect at least similar revaluation uplifts to what we saw last year, i.e. when we had a growth of 5%. We offer 3.78 euro per share as dividend for the last business year, leading to attractive yields in broader stock market context. Coming now to my second point, why we are different. The following chart shows you on the x-axis on how our gross yield compares to peers, and on the y-axis the loan-to-value ratio, i.e. how much leverage those companies take. You see that we screen very well in the upper right-hand part of the chart, showing that we achieve still attractive yields in peer comparison at reasonable leverage. What you also see on the lower part of the chart is that we focus exclusively on one asset class. And as I said at the beginning, within this, we focus on the affordable segment. And we also focus, as I just highlighted, on Germany only, which is why we regard ourselves as the pure play amongst our peers. Therefore, we do not engage in international expansion, as we see only limited cross-border synergies for the management of those real estate assets. Additionally, we do not engage in other asset classes, as especially this crisis proved that senior living, hotels, commercials, etc., to be much volatile than originally perceived. We also do not venture into development activities by buying into a developer, as our peers did, for example. So development always comes with long tail risks and adds balance sheet risks, which seems to be especially challenging in times of economic uncertainty. We certainly have development projects, but it is mostly via redensification projects on own land, or we buy fully developed projects from external developers. Let me now also touch on our financial situation, what you saw just on the y-axis in respect to the LTV. As said, we run on a very solid and conservative financing structure. As you see on the left-hand chart, we have no upcoming maturities until 2023. We have an average maturity of 7.5 years. We have low financing costs of 1.9%, and our LTV, i.e. our leverage, stands at 37.7%. This is comfortably below our maximum level of 43%, and it provides us with sufficient flexibility to react to opportunities. And we have a Baa1 rating from Moody's, which provides us also with sufficient security, but leaves us also flexibility. Let me now touch on ESG, where we just provided the markets with some more details on our ESG agenda. On this slide, you find our path to climate neutrality, which we expect to reach by 2045. We introduced our environmental targets already last year, as they are part of management's remuneration system, and we have broken it down into our organization. The first target is to energetically refurbish 3% of our units in 2021. And the second target is to reduce carbon emissions of our units by 10% until 2024. We believe that those are ambitious targets. We believe that there will be also some innovation along the journey when it comes to building materials and processes, the production of green power and heat, as well as the change of consumer behavior. However, there is also a high degree of uncertainty behind our assumptions, which is also driven by the long time horizon we have to face. Therefore, we have chosen not to simply draw a straight line from our current CO2 footprint to the targeted one, but instead to opt for a corridor which leaves space for change and innovation and takes into account the uncertainties we face along our journey. Let me now show you how we believe we get there. So on this slide, you see the three key drivers to this climate neutrality. Following the size of the contribution there are firstly the energy transition, secondly the effect from energetic refurbishment, and lastly the consumption behavior of our tenants. The energy transition should contribute around 70% to our climate neutrality. This will be mainly done via a shift from fossil heating resources to green district heating and green electricity. We believe we are here in a very good starting position, as 30% of our heating energy comes already via district heating today. The second pillar, the energetic refurbishment, should contribute up to 30% of our improvement. There, we will need to change the way we do those refurbishments. We shift from individual measures to a more holistic approach going forward to achieve a higher energetic efficiency improvement going forward. And finally, we expect also that the tenant needs to contribute to the overall improvements, as minor shifts in tenant behavior can have a significant impact. With this roadmap, we have provided also some numbers to the markets. Until 2024, we expect to invest between 450 and 500 million euros into energetic measures, and until 2030, around 1.5 billion. This compares to around 110 million, which we expect to invest, for example, in 2021 for pure energetic measures. And it indicates that we should be able to execute our roadmap in the short and midterm broadly at an investment level that is similar or slightly higher than what we see already today. Certainly, we will make use of available subsidies, which are available under the new BEG scheme wherever possible. And with this, let me now run through the guidance. We are well on track just after a strong set of results in Q1 to reach our guidance, which we just confirmed. So for 2021, we expect further growth. We expect an FFO1 in the range of 410 to 420 million euro, and this would represent a growth of roughly 8%, taking the midpoint of our range into account. Growth should be driven by rent increases, and it will be also driven by our acquisitions, which we did in 2020. We expect rents to grow on a like-for-like basis by 3%. Due to effects from acquisitions, we expect to increase our EBITDA margin by around 100 basis points to around 75%. We will invest around 40 to 42 euro per square meter. A big part of it is going into modernization projects and supporting future rental growth. We also stick to our conservative balance sheet and continue to aim for an LTV of a maximum of 43%. This gives us sufficient firepower for further growth. And we aim again to acquire around 7,000 units in 2021, which is roughly 5% of our existing portfolio. Please be aware that the effects from those potential acquisitions are not yet included in the 2021 guidance. And you see also that by now we also reflected our ESG targets into our target matrix. And with this, I come to the end of my short presentation. I hope you found it useful and I provided you with a first understanding of who LEG is and what we do and why we are successful. Should you wish to have a follow-up with me, the team or the management, then please do not hesitate and contact me or the team. And we are happy to support you in your investment process. You find all our contacts and as well as the documents certainly on our webpage, which is www.leg-se.com. And with this, I thank you for your interest and I wish you all the best and goodbye.
Hi there, since you watched this company video until the end, I'm guessing you liked the video. And that's probably because we work very hard to create the most engaging and added value content for you. If you're a company and want to find out how we, at Seat 11A, can make a company video with and about you, please email us at content@seat11a.com.